Turkey's central bank has almost doubled the cost of borrowing to 15% in a bid to cool runaway inflation.
The decision by the country's new economic policymakers falls short of what the markets were expecting. The lira has halved in value over the past 2 years, and it fell to a new low after this rate rise was announced. It's now worth more than 24 to the dollar. Some top Wall Street banks say tougher action is needed to try to tackle Turkey's economic problems. Well, let's talk to Atilla, Yesilada, a specialist on the Turkish economy at GlobalSource Partners. Atilla, welcome back to the programme. Good to see you. Well, this was the first opportunity for the new central bank chief and the finance minister to prove their worth and get a grip. Have they done it?
No, they have completely failed. I call this not monetary tightening, but monetary tickling. We're not fighting inflation by choking the breath out of it, but by tickling it slowly to calm down. You live in a country where headline inflation is 40%, trend inflation is 45% and accelerating, and you raise the policy rate to 15%. Why bother? So, A, they have really lost credibility from the word go. B, these interest rates don't do anything to calm down housing demand or consumer durables demand. 3, it would not stop dollarization of the economy. And 4, it will not really bring in any foreign financial investment that's badly needed to replenish the FX reserves of the central bank.
Well, that's a very blunt assessment. I mean, so if this doesn't work, what next? What now?
Well, I think they'll tighten a few more steps, but if the scuttlebutt is to be believed, the new economy czar Mehmet Şimşek has cut a deal with President Erdogan not to raise interest rate beyond 25%. It so appears that a lot of the weight of balancing the economy, that is reducing the current account deficit, and in their view, reducing inflation will fall on weaker currency. That's the Turkish lira will lose more value. And of course, the second thing is loans will not be available to the businesses and the households. That should also slow down the economy. But I'm not going to give you a long technical discussion. This is a very poor start. There is no way a central bank can catch up to 40% inflation when they're moving at a rate of 15%. So at the end, by the end of the year, when tourists go home, Turkey will be faced with the possibility of another devastating currency crises.
Who do you believe is calling the shots here? I mean, does President Erdogan, still have a hold on economic policy?
Yes, I think so. Put it this way. During the previous administration, Erdogan phoned in to the central bank as to what needs to be done. Now, he apparently outlined to Mehmet Şimşek and Ms. Gaye Erkan what can be done. They are free to move within those parameters. The problem is the set parameters don't do anything to solve Turkey's chronic and very entrenched inflation or current account deficit problems.
It's good to talk to you. Thanks very much indeed for coming on the programme. Atilla Yesilada, a specialist on the Turkish economy at GlobalSource Partners in Istanbul.